Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Martin. Alan, I recently, by mistake, placed a stop sell order on a stock I had already sold a call. The stock was sold days after I purchased it. Why was I allowed to place the sell stop to begin with? Actually, I was thinking this may be a positive in that I can buy back the stock at a lower price to cover the naked call. Is this a better strategy than rolling down? Martin. Well, Martin, let me start off with a quick answer. No, I don't think this is a better strategy than rolling down or use any other of our position management techniques. Because what happened here is you ended up in a naked options position, which is a lot riskier than our go-to strategy of covered call writing. So let's first have a review of Martin's dilemma. We'll evaluate it and see if we can come up with some better ideas. Okay, on the screenshot in front of you, you could see that Martin first purchased the stock, we'll just call it company XYZ, and then sold an option, we'll call it option A. Then a sell stop limit order was placed on the stock itself, not on the option. For those of you familiar with my books and DVDs, you know that once we enter a trade, the limit order is placed on the option. We use the 20%, 10% guidelines to first deal with the option side of things. So if we had sold an option for $2, we could set a buy to close limit order at 40 cents or less in the first half of the contract, and then change it to 20 cents or less in the latter part of the contract. But in this case, the sell stop was placed on the stock itself. And the threshold was in fact reached, and the shares XYZ were sold, leaving us in a naked options position with option A. So the first question was, why was this sell stop permitted, and can this be a valuable tool for us, which I've already answered. I don't think so, but we'll talk more about that shortly. Let's next deal with why was the sell stop permitted. Well, in the screenshot in front of you, you could see that there are various levels of trading approval. Now, one possibility here is that Martin had the same level of trading approval that most of us have, which is level 1, or some brokers even refer to it as level 0, which is for covered call writing and buying protective puts and that sort of thing. So the most conservative of the option strategies. But if we were going to be in a naked options position, we would be up here, in this particular case, up to level 4, much higher level of trading approval, which has much stricter requirements. So if Martin was in level 1, then it could be broker error that caused this trade to go through. I mean, after all, there are human beings at the other end of these computers, and there could be some human error involved here. But more than likely, Martin did have a higher level of trading approval that permitted naked options trading, and that's why this trade was permitted. Now, in order to get that higher level of approval, client would have to request it, and only Martin knows whether or not he did request it, but there are usually forms to fill out, and you're going to request the level of trading approval that you would like for the particular strategies that you're using. And then the broker will evaluate it based on our trading experience and sophistication. There'll be a bunch of questions that we have to answer, and if we do have a history of using some of these higher level strategies, we have good experience. And if our portfolio and personal net worth is high enough, then we may get approval. Brokers have to be very careful because they have to abide by what's known as the KYC rule, know your customer. And they could be subject to different forms of litigation if they put their clients in an inappropriate strategy based on the factors that I just alluded to. So again, more than likely, Martin had requested a higher level of trading approval, which did allow him to trade in naked options positions. So next, I would like to show you some of the ramifications of being in these naked options positions and what can happen. Here is a price chart for the Spider Gold ETF, ticker symbol GLD. The blue arrow shows the security declining in value from 124 down to 108. And then as soon as that happened, boom, it bounced back up from 108 up to 115. So had we sold, let's just use as a hypothetical here, had we sold the in-the-money 110 call and then sold the underlying security because we had set a sell stop limit order at 110, and now the stock price bounced back up to 115, well, that means that we would have to buy the stock at 115 to provide shares at the 110 strike price. We would lose $5 per share. That could hurt us quite a bit. So again, and there are situations here where this can even be much worse than the one shown in this particular screenshot. So this is the reason why we don't want to find ourselves in a naked options position unless we know what we're getting into, our personal risk tolerance is quite high, and we're looking to really hit that grand slam home run. We're looking to make a lot of money quickly, as opposed to strategies like covered call writing and selling cash secured puts, where we're basically hitting singles and doubles, never really getting that grand slam home run effect where we make a lot of money in a short period of time, but making significant money, short amounts, small amounts of money, but a lot of them over time. And that's basically what covered call writing and selling cash secured puts is all about. So how do we avoid a naked options position? What happened here with Martin? Well, it's incumbent upon us to know our level of trading approval and the types of trades that our broker will permit. In this particular case, if Martin was aware of the fact that he could use naked options trading, perhaps he would have known not to set that limit order on the stock itself. Set your limit orders on the short calls first. Could be automated, 20%, 10% guideline if you're in line with the BCI methodology. And then if it's hit, then you can make a decision as to whether or not you're going to sell the stock, roll down to a lower option, wait and hope to sell another option in the future if the price bounces up. We call that hitting a double, or any of our other position management techniques. I would also dedicate my portfolio for the particular strategy that you're using. So if you're using covered call writing, and let's say you're also doing naked options trading, and let's say you also have a long-term buy and hold portfolio, set separate portfolios for each strategy, and this way there'll be no confusion as to how to manage your positions. Here's my covered call writing portfolio. If I'm going to close a position first, it's always going to be my short call. Here's my naked options portfolio. I know that it's riskier. I'm going to watch these like a hawk every single day to make sure that I don't put myself in a situation where I'm going to lose a lot of money quickly. Here's my long-term buy and hold portfolio. I know I'm not going to sell any calls on it unless using portfolio overriding, in which case the strategy will be a little different from your traditional covered call writing portfolio. So there you have it. There are ways to protect yourself. It's incumbent upon us to know our level of trading approval and what our brokers would permit, and then to stay within the guidelines of the strategy that we're using in that particular portfolio. Okay, I want to thank Martin for sharing that trade with us and allowing us to create this video. And of course, I want to thank everybody out there for taking the time to watch this video. Hope you enjoyed it, and I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.